In October 1997, two academics flew to Stockholm to accept the Nobel Prize in economics. 11 months later, the hedge fund built on their mathematics had lost $4,600,000,000 and threatened to take Wall Street down with it. At 7 p.m. on the 23rd of September, 1998, the CEOs of 16 of America's largest banks arrived in unmarked town cars at the New York Fed. They had been summoned that afternoon by the president of the New York Fed, William McDonough, with no warning, no agenda, and no public explanation. When they sat down in the 10th floor conference room, McDonough told them what they were there to do. They were going to pool between them $3,600,000,000 in private capital. Tonight, in cash, to prevent the failure of a single hedge fund based in Greenwich, Connecticut. The fund was called Long-Term Capital Management. It had been founded by John Meriwether of Salomon Brothers. Its strategy had been designed by Robert Merton and Scholes. The two academics now stamped with a Nobel. In the previous 4 months, that fund had lost $4,600,000,000. And it still held positions worth, on paper, approximately $1.25 trillion. Larger than the GDP of Russia, larger than the GDP of Canada. If it failed disorderly, those positions would have to be unwound into a market that did not have the liquidity to absorb them. The banks were in the room because every one of them was on the other side of one of those positions. The first government-coordinated, privately funded rescue of a non-bank financial institution in American history was about to begin. The doctrine it established would be invoked exactly 10 years later, in September 2008, and again in March 2023. How 14 of the most powerful banks in the world came to be summoned to rescue one fund is a story that begins with the man who built it. John Meriwether grew up on the south side of Chicago. He took a business degree at Northwestern, an MBA at the University of Chicago, and in 1974, at the age of 26, joined Salomon Brothers in New York. By the early 1980s, Meriwether ran Salomon's bond arbitrage desk. He had a method. He hired physics PhDs and former chess prodigies, people whose intuition for risk had been trained on chalkboards, not trading floors, and he gave them small books and complete autonomy. By the late 1980s, the arbitrage desk was generating an estimated several $100 million a year in profits. By some accounts, the most profitable unit inside Salomon. It was, in private inside the firm, called the smartest desk on Wall Street. In 1991, Paul Moser, the head of Salomon's government bond desk, was caught submitting fraudulent bids in a treasury auction. Meriwether was Moser's supervisor. He resigned that August and was later fined $50,000 by the SEC for failure to supervise. He spent 2 years in the wilderness. And then, in 1993, he began making calls. By February 1994, he had assembled what may have been, on paper, the most academically credentialed financial firm ever launched. Roughly a dozen founding partners, most of them veterans of Meriwether's Salomon arbitrage desk. 2 future Nobel laureates, 1 former vice chairman of the Federal Reserve, $1.25 billion in committed capital. Long-term capital management. The mathematics that allowed long-term to work was not invented at the fund. It had been invented 21 years earlier in a small paper published in May 1973 in the Journal of Political Economy. The paper was titled The Pricing of Options and Corporate Liabilities. The authors were Fisher Black and Scholes, working at the University of Chicago. Robert Merton at MIT published a companion paper in the same season. Together, the 3 of them solved a problem that had defeated mathematical economists for 70 years. The problem was this: how is an option to buy something in the future priced when its price is not yet known? Their answer rested on a chain of assumptions about how prices move. Markets, they argued, behave like Brownian motion, the random walk of particles in fluid. Model that randomness, and the fair price of any derivative contract can be computed. What this meant practically was that anyone who understood the Black-Scholes-Merton equation could identify mathematically when 2 related securities had drifted out of their natural relationship, and bet with quantifiable risk that they would converge again. Long-term capital was built to be the perfect machine for executing those bets. The play: find a tiny spread between two near-identical bonds, borrow heavily against equity, hold until the spread closes, pocket the difference. The strategy was called convergence arbitrage. By 1996, long-term was leveraged at 25-to-1. For every dollar of investor equity, the fund controlled $25 of bonds. For the first 3 full years of its life, long-term capital was the most profitable hedge fund in the world. 1994, returns of 20% after the 2% management fee and the 25% performance fee. 1995, 43%. 1996, 41%. 1997, 17%. Quieter, but on a much larger asset base. By the autumn of 1997, the fund's equity capital had grown to $7.5 billion. It had nearly tripled the original investor capital, net of fees. Wall Street competitors had begun to copy its trades, sometimes openly, sometimes through ex-long-term staff. The convergence pool was getting crowded. On the 14th of October 1997, the Royal Swedish Academy of Sciences awarded the Nobel Prize in Economic Sciences to Robert Merton and Myron Scholes. Fisher Black had died of throat cancer 2 years earlier, in 1995, ineligible posthumously, for in the official citation, a new method to determine the value of derivatives. A photograph from the Stockholm ceremony shows Merton and Scholes in white tie, accepting medals from the King of Sweden. They were the official intellectual godfathers of the modern derivatives market. Within 11 months, the firm built on their mathematics would be insolvent. The catastrophe began in Asia. The Thai baht collapsed in July 1997, and by autumn the contagion had hit South Korea, Indonesia, and Malaysia. The International Monetary Fund and partner institutions, the World Bank, the Asian Development Bank, and bilateral lenders, extended emergency lines totaling more than $100 billion to stabilize the region. Long-term took losses, but survived 1997 with a positive year. The real wound came on the 17th of August 1998. On that Monday morning, the Russian government widened the ruble's trading ban, an effective devaluation of roughly 1/3 against the dollar, declared a 90-day moratorium on its commercial foreign debt repayments, and announced a unilateral restructuring of approximately $40 billion of GKO ruble-denominated treasury bills. By late September, after the ruble was floated, it had lost more than 60% of its value. In one statement, Russia had defaulted on its own currency, the most consequential sovereign default by a major economy since the Latin American debt crises of the 1980s, and uniquely on debt denominated in its own currency. What happened next was the failure mode that the Black-Scholes-Merton model did not contain. Investors holding any kind of risky asset, emerging market debt, high-yield corporate bonds, U.S. Treasury issues with low liquidity, sold everything and bought the safest asset on earth, 30-year on-the-run U.S. Treasury bonds. This was called the flight to quality, and it was the exact opposite of convergence. Spreads that the long-term model said should have been narrowing widened, violently, simultaneously, across every market in the world. The fund was on the wrong side of essentially all of them. What follows is the bleed of long-term capital, week by week. Friday, 21st of August, 1998, 4 days after the Russian default, a single-day loss of $550 million, the largest one-day loss in the fund's history. The partners are still confident. The model still says the spreads must converge. Monday, 24th of August, 1 week after the default, the fund's net asset value has fallen from $4.1 billion to $3.8 billion, a 7% drop in 5 trading days. Manageable. Monday, 31st of August, the Dow Jones falls 512 points, the second worst point decline in its history at the time. Long-term loses another $500 million. By the 2nd of September, the fund has lost 52% of its capital since the start of the year. By the 10th of September, it is down to $1.5 billion. Counterparties begin to whisper. Inside the firm, the partners stop sleeping. They take cots into the trading room. Warren Buffett reached on a cell phone while crossing Yellowstone with Bill Gates and former Capital Cities ABC chairman Tom Murphy, joins a consortium with AIG and Goldman Sachs that, on the morning of the 23rd of September, faxes a written offer to buy the fund outright. $250 million to the existing partners, $3.75 billion in new equity from the buyers. A takeover. Meriwether and the partners would have been removed. The offer carried an hour-long deadline. LTCM's lawyers concluded the partnership structure made it impossible to accept in the time given. Goldman, meanwhile, had a team inside the books, and the partners later alleged they were front-running positions in the open market. By the 20th of September, the fund has approximately $500 million in equity capital, against approximately $1.25 trillion in notional derivative exposures. If it failed and those positions had to be unwound at once, the people unwinding them would be the only buyers, at prices nobody could survive. On the morning of Wednesday, the 23rd of September 1998, William McDonough, president of the Federal Reserve Bank of New York, made a series of phone calls. McDonough was not a celebrity central banker. He was a 64-year-old career banker who had spent 22 years at First Chicago Corporation, rising to vice chairman before joining the New York Fed in 1992. Flat Midwestern accent, yellow legal pad notes. The phone calls he made that morning were to the chief executives of Bankers Trust, Barclays, Chase Manhattan, Credit Suisse First Boston, Deutsche Bank, Goldman Sachs, J.P. Morgan, Lehman Brothers, Merrill Lynch, Morgan Stanley, Paribas, Salomon Smith Barney, Societe Generale, and UBS. And one more, Bear Stearns. Each one received the same instruction. Come to the New York Fed at 7 in the evening. Bring no advisors. Bring authority to commit capital. At 7 p.m. Eastern, in the 10th floor conference room, McDonough laid out the situation. Without coordinated intervention, long-term positions would unwind into the open market over the following 5 trading days. He estimated the contagion could cost the system between $150 and $250 billion in losses. The banks in the room held most of the counterparty exposure. Then he made the proposal. Each of the 11 largest banks would commit $300 million in fresh equity to long-term. Smaller participants, Lehman, Societe Generale, Paribas, would contribute proportionally less. The Fed would not contribute capital. The Fed would coordinate. By midnight, 14 of the banks in the room had committed $3,625 million in private capital. No federal funds, no public statement. One bank refused. Bear Stearns, long-term's own prime broker. Remember that name. The political reckoning came almost immediately. On the 1st of October 1998, the chairman of the Federal Reserve, Alan Greenspan, was called to testify before the House Banking Committee. The chairman was asked repeatedly why the central bank had organized a rescue of a private hedge fund whose investors had voluntarily accepted leverage of 25-1. Greenspan answered in his careful Greenspan clauses that the Fed had committed no public funds. It had brokered a private agreement among consenting banks, all of whom were already on the hook for the losses. The alternative, a disorderly unwind, would have been catastrophic for the broader financial system. Markets would have seized. Liquidity would have evaporated. Ordinary depositors and policyholders, with no relationship to long-term, would have suffered. What Greenspan did not say in October 1998 was that the architecture he had just sanctioned would become the template for every major crisis that followed. The doctrine, in a sufficiently interconnected financial system, certain institutions are not allowed to fail disorderly, regardless of whether their failure was earned by their own choices. A doctrine that would, 25 years later, be law. The doctrine that McDonough drew up in 12 hours on the 23rd of September 1998 has been invoked in some form in every major financial crisis since. In March 2008, Bear Stearns, long-term's prime broker and the lone holdout that refused to contribute to the 1998 rescue, was itself bailed out under exactly the same logic. In September 2008, Lehman Brothers was allowed to fail. Within 48 hours, global credit markets froze, and on the 29th, the Dow lost 778 points in a single session, the largest point drop in its history to that date. In March 2023, Silicon Valley Bank's depositors were made whole over a single weekend. The doctrine does not get smaller, it compounds. Next time on Empires of Money, Enron, the company that pretended its losses were profits.